was 2008, right in the middle of the financial crisis. I remember standing in my office, looking into the lobby as one of our wonderful clients walked through our door for her meeting. She paused, talking with our staff, and I could see it on her face. Tension, fear, that quiet panic so many people were feeling. I could even feel myself take on that tension. And when she sat down across from me, her voice shook when she said, "What do we do?" And that moment taught me something I've never forgotten. Sometimes the most powerful thing you can do is not to just stay the course. It's to take action. Small, intentional steps that keep you anchored and actually move your plan forward. Since then, I've seen those small moves make a big difference in outcomes, in confidence, and peace of mind. In this video, I'm going to show you 6 strategies retirees can use when the market is down, ranked from helpful to game changer. Let's start our countdown with number 6. Let's say you started the year with a 60-40 portfolio, 60% stocks, 40% bonds and cash. After a drop in the stock market, that could drift to say 50-50. Safer on paper, but also with less growth potential moving forward. Realigning your investments back to your original target forces you to do what most people avoid. Sell what's gone up and buy what's gone down. And while it may not be the flashiest move, rebalancing consistently over time can add real value. Research by Michael Kitces shows that using tolerance bands, ideally 20% thresholds, and then monitoring your portfolio every 5 to 10 days for out of tolerance signals can actually add about 0.38% in return. For comparison, annual calendar rebalancing tends to add 0.1 to 0.2%. So while it's not quite as statistically beneficial, calendar-based rebalancing may be easier to implement and still adds value over time. Think of it as buying low on autopilot. Number 5, most people see red in their portfolio and think, well, that's just the market. But if you know what to do, those losses can actually work for you. The strategy of selling investments that have dropped in value, capturing that loss in your tax return, and then reinvesting into a similar, but not identical, another holding is proactive and can make up some of that loss. With tax loss harvesting and replacing your investment, you stay invested, but you create a tax asset. So let's say you bought a position at $50,000 and now it's worth $40,000. You sell, capture a $10,000 loss, and reinvest in a similar fund. You haven't changed your strategy, but you now have a $10,000 loss to use against capital gains. And here's what some people miss. If your losses exceed your gains, you can use up to $3,000 of capital losses per year to offset higher ordinary income tax rates. That's especially helpful in a high income year. Just avoid wash sales, which is rebuying the investment you sold within 30 days after or even before the sale. So make sure to coordinate this with your tax advisor. Number 4, most people think about what they own, fewer think about where they own it. In a down market, you get more flexibility to reposition assets with less tax impact. Let me show you what I mean. In a taxable account, you typically want tax-efficient investments like ETFs, stocks with low dividends, or perhaps even tax-free municipal bonds. In a traditional IRA, high yield or interest-producing assets are better placed here since this investment income is deferred. And in Roth, that's typically where you want your long-term growth. Downturns are a chance to shift. For example, let's say you want to increase the growth potential in your Roth IRA, and to compensate, you sell stocks in a taxable account while values are low. This effectively shifts where you hold the growth instead of simply adding risk. That moves recovery and future growth into a tax-free zone. We call this asset location. But there's a nuance to consider. When you consider shifting for tax purposes, you'll also want to watch your allocation in relation to where you're making withdrawals if you're in or nearing that retirement income stage. In other words, if you're in the midst of heavily drawing from one particular account, you may want to lean more conservative on the investment side. The point isn't perfection, it's alignment of tax efficiency and income optimization. So make sure to match investments to the account where they're taxed the least and align risk based on when you'll actually use them. 3, your IRA may show a balance of $1 million, but what if I told you that's not all yours? If you're in a 22% federal bracket, and let's say in my home state, 9.3% California state tax is common, well, that's 31% in total taxes, meaning $310,000 of that IRA is already earmarked for the IRS and the state. You can apply that with your own tax rates. We don't have a way to eliminate the IRS from retirement money. If you do, please let me know. But we can minimize what they take. And the opportunity in a down market magnifies the benefit of a strategic Roth conversion. So what you may already know, you move money from your traditional IRA where all the withdrawals are taxed to a Roth IRA where future growth is tax-free. The trade-off is paying tax today to avoid paying more later. But let's look at an example of why timing is key if you want to get your revenge on that down stock market. Say your $100,000 IRA drops to $75,000 in a downturn. you convert at that lower value and pay tax on the $75K. Then as the market recovers and let's say it hypothetically grows to $120,000, well, all of that recovery gain is tax-free in the Roth, and now you've had the last laugh at the market. Now, real quick, not everyone should convert, or you should at least pick your spots. I walk through this in more detail in my video, 9 reasons not to convert to a Roth in retirement. I'll drop a link in the description. But for many retirees in their early 60s, especially before RMDs or Social Security kick in, this is the window to reduce the IRS's share without overpaying to do it. You're not eliminating the tax bill, but you are buying it out at a discount when the market is down. Now, number 2 seems obvious. When the stock market is down, stocks are on sale. But what if I told you what sounds simple is not easy, which is why most retirees miss this? It's often the last thing they want to do. That's because the news is the worst and it often feels like it won't get better, that this time is different. In 2022, for example, with markets down, we helped several willing clients make small allocation shifts, let's say from 60% stocks to a 70-30 allocation. The goal wasn't to time the market perfectly. It was to take advantage of lower prices while still protecting their ability to draw income for several years. And yes, the question always comes up, well, what if it goes down even more? That's why we often take a systematic approach. For example, shifting 2% per month until the new allocation is reached. That spreads out the risk and keeps some dry powder ready. Now, if you're still working, another option is to direct all new 401k contributions into stocks for now while they're down. You're buying more shares at a lower price without changing your current balance of funds. It's not about making a big bet. In fact, reducing the conservative bucket is not for everyone, but it's about being intentional and taking advantage of an opportunity while not overplaying your hand. Okay, every strategy we've talked about works better when this one is right, which is why this is number 1. Because if you're taking income from your portfolio, how you do it during a downturn is everything. It all comes down to sequence of returns risk. When you're building wealth, the timing of returns, which we can't control, doesn't matter all that much. So all 3 portfolios, good early, bad early, and steady, end up in the same place, assuming the same average return. But once you start withdrawing income, the order of returns matters a lot. In this scenario, all 3 portfolios still have the same average return, but the portfolio with the bad early returns runs out of money first. So how do we guard against sequence of returns risk since we can't control the market? First, we use a bucket strategy. Cash for short-term needs, bonds for midterm, stocks for the long-term growth. When the market drops, you pull from cash and bonds. So yes, this might temporarily tilt your allocation more towards stocks, but also because stocks are down, that tilt often self-corrects. But in either case, you can rebalance later. By taking income from your conservative war chest, what this does is prevent you from being a forced seller of stocks when they're down 20, 30, or even 40%. Instead, you draw from more stable investments and let the stocks recover. But even when this is in place, the question often comes up, should I reduce my income since the market is down? It's a valid and even a responsible question. Back in 2008, I remember clients were willing to make adjustments. They just wanted to know if they needed to and by how much. Now, at the time, we used planning software that wasn't yet built for granular retirement withdrawal decisions. Today, we can do better through improved technology. We now use risk-based dynamic guardrails. These set thresholds for when income needs to be adjusted. Let me show you. Okay, so let's say a client has a $2 million portfolio. If it grows to about 2.5 million, the plan recommends an income increase. If it drops near 1.4 million, it calls for a reduction. These are not static numbers. They dynamically adjust based on personal and economic factors. So now let's apply a historical test against the 2008 Great Financial Crisis. So as the market fell, they would have needed to reduce income by $400 and then another $800. Then as the market recovered, income returned to plan levels and even increased above plan by managing it well. This is hard to manage with a spreadsheet. That's why we use a dynamic risk-based system. Volatility is normal, but withdrawing the wrong way can lock in losses, making it difficult to recover. But get this right, and everything else has room to work. Getting the investment plan right is crucial, which is why the next video you're gonna wanna watch is, here's what a $3 million retirement portfolio looks like. It'll give you a clearer picture of how the investment pieces fit together. You can find that here. And if you want help applying these strategies to your own plan, that's what me and my team do every day with clients. You can schedule a call to see if we're a good fit to help you using a link in the description. Thanks for watching, and I will see you on the next one.